and that's highest price since May 2022, possibly due to an uptick in DApp use and a few other key factors. So, and Solana's native token experienced an impressive 22% surge on November 10th, breaking past the $54 mark for the first time since May 2022. Notably, this surge occurred amid the continuous selling of SOL tokens by FTX's bankruptcy estate. The Delaware Bankruptcy Court approved the sale of the failed exchange FTX assets, which included 55.75 million SOL in September 2023. And investor enthusiasm for SOL's price increase may be attributed to the fact that some of the tokens from the bankruptcy proceedings are either vested or locked. Furthermore, there's a weekly sale limit of $100 million imposed as part of the FTX liquidation plan. In essence, the initial fear of asset liquidation is transformed into hope as investors realize the limited impact of the sales. And FTX has been selling between 250 to 700 K SOL every day for the last 2 weeks, while price either been going up or sideways. So far, it's been getting absorbed with a champ, and at that current rate, their unlocked tokens should be depleted within a week. Once this seller is gone, I can. As trader and independent analyst Blunts amply described the situation, SOL's resilience during the FTX bankruptcy token dump is impressive. The post on X, formerly Twitter, adds a bullish relief, the second sensor 2000 case, to time B positive access. Now before SOL's substantial 39% weekly gains have pushed its futures open interest to $745 million, the highest level since November 2021, when SOL achieved its all-time high of $260. Still in futures markets, leverage longs and shorts are constantly matched, so it's crucial to examine SOL's funding rate for a more nuanced perspective. And, a positive funding rate indicates that longs buyers demand more leverage, while the opposite occurs when shorts require additional leverage, resulting in a negative funding rate. SOL's current futures funding rate represents a 0.5% weekly cost for leverage longs, which is not excessive given the prevailing bullish momentum. Yet this is a significant shift from the funding rate levels observed 3 weeks earlier when leverage shorts were paying for leverage use. While it could be argued that SOL's rally was primarily driven by derivatives markets, there's solid evidence indicating growth in terms of deposits and the usage of decentralized applications. And that's what it does, is it does DApps within the Solana ecosystem. And that's Solana's total value lock, which measures the amount deposited in its smart contracts, has reversed its declining trend after 6 consecutive weeks. And Solana's DApps deposits have seen a 10% increase in the last 3 days. And while the current 11.1 million SLO level is still below the 30 million SLO to the FTX exchange bankruptcy, this recent trend suggests that the worst period for the Solana network may be behind us. To confirm that this movement isn't solely driven by a few large holders inflating TVL, it's essential to analyze the number of users employing active addresses as a proxy. And Solana now ranks as the 4th largest blockchain in decentralized finance TVL, accompanied by a 28% growth in the number of active addresses. Interestingly, this surge in activity occurs while competitors experienced declines, with market leader Ethereum facing a 22% drop in DeFi active users, according to DApp Radar. On one hand, SOL token bulls benefit from the increased network activity and higher TVL, while on the other hand, Solana's current market capitalization of $22.8 billion has surpassed in Polygon's $7.8 billion by nearly threefold. Despite both networks having comparable DeFi TVL, this has prompted investors to question the sustainability of SOL's bull run above $54. Additionally, Solana protocol's accumulated 30-day fees amounted to $1.9 million compared to Polygon's $1.6 million, according to DFolana. However, these figures pale in comparison to BNB Chain's $9.1 million, raising doubts about the valuation after SOL's recent rally. As of now, there is no evident reason to bet against the trend, as there is no excessive leverage demand observed in SOL derivatives contracts. Nevertheless, the fundamentals hint to limited room for further upside.